Hello, good day. I hope to take this opportunity to wish you a happy Lunar New Year. May you have a happy and joyful New Year. I'm happy that our learning journey continues during the joyous time of the year. Do you know that in addition to paying cash dividends, there are other ways in which companies can reward their shareholders? Have you heard about stock repurchase? What are the implications of stock repurchase to shareholders? Why companies have stock dividends and stock splits? Well, in this video, we are going to learn the basic concepts about stock repurchase, stock dividend, and stock split. At the end of this learning session, it is hoped that students will be able to define, compare, and justify these alternative methods of delivering value to shareholders. In addition, it is hoped that students will be able to explain why a firm might have stock repurchase, stock dividend, and stock split, and their implications. A stock repurchase occurs when a firm repurchases its own stock. Stock repurchase is also known as share buyback. Stock repurchase is an alternative way to pay cash to investors. In this kind of transaction, the firm uses cash to buy its own outstanding common stocks. These shares are generally held in the corporate treasury, and they can be resold if the company needs to raise money in the future. There are four main ways to repurchase stock: open market purchases, tender offer, Dutch auction, targeted repurchase. We will learn about these methods one by one in the next few slides. In open market purchases, as the name suggests, firms simply buy back some of their outstanding shares from the open market. A firm announces its intention to buy its own shares in the open market. Shareholders must be informed of the company's intentions and then proceeds to do so. Also, the firm must not buy its shares in a way that might appear to manipulate the price. Like any other investors, a company buys its stock through a brokerage house. Usually, the brokerage fee is negotiated. Firms have a great deal of latitude regarding when and how they execute these open market purchases over time. Some firms make purchases in fixed amounts at regular intervals, while other firms try to behave more opportunistically, buying back more shares when they think the share price is relatively low and fewer shares when the price is high. The firm may take a year or more to buy the shares. The firm is not obligated to repurchase the full amount it originally stated. There is no one unique or fixed price at which the shares are to be repurchased. This method is flexible and less documentation is required. A tender offer is where all shareholders are invited to sell back their shares at a price set by the company. A company announces the price it is willing to pay to buy back shares and the quantity of shares it wishes to repurchase. The tender offer price is usually set at a significant premium above the current market price. In general, the transaction costs to the firm in making a self-tender offer are higher than those incurred in the purchase of stock in the open market. Usually, the tender offer period is over a short time interval between 2 and 3 weeks. The main advantage with this method is that it allows all shareholders to participate in the repurchase. Shareholders can elect either to sell their shares at the specified price or to continue to hold them. Shareholders who want to participate let the firm know how many shares they would like to sell back to the firm at the stated price. If the offer is oversubscribed, meaning that shareholders want to sell more shares than the firm wants to repurchase, then the firm typically repurchases shares on a pro rata basis. If shareholders do not offer to sell back as many shares as the firm wants to repurchase, the firm may either cancel or extend the offer. In a Dutch auction, the firm specifies a range of prices at which it is willing to repurchase shares and the quantity of shares that it desires. Shareholders in turn indicate how many shares they are willing to sell at each price. The firm then pays the lowest price at which it can buy back its desired number of shares. Typically, the minimum price is slightly above the current market price. In a targeted repurchase, a firm may purchase shares directly from a major shareholder, who can be specific individual or institutional shareholder. This method of repurchase is sometimes known as an agency buyback. In this case, the purchase price is negotiated directly with the seller. A targeted repurchase may occur if a major shareholder desires to sell a large number of shares, but the market for the shares is not sufficiently liquid to sustain such a large sales without severely affecting the price. Under these circumstances, the shareholder may be willing to sell shares back to the firm at a discount to the current market price. Alternatively, the shares of large shareholders are often repurchased to avoid a takeover unfavorable to the management. If a major shareholder is threatening to take over the firm and remove its management, the firm may decide to eliminate the trade by buying out the shareholder, often at a large premium over the current market price. This type of transaction is called greenmail. Next, we are going to look into an example to compare the differences between dividend payment and share repurchase. This example on telephonic industries is modified from your prescribed textbook by David Hillier. This slide summarizes the background of the company. Telephonic industry has excess cash of £300,000. There are 100,000 shares outstanding. The price-earning ratio is 6 times. The firm forecasts that earnings will be £450,000 per year after dividend payment. Assuming that in scenario 1, the company is considering an immediate extra dividend payment of £300,000 or £3 per share. Answer the following 4 questions. There is a little answer at the end of this slide to motivate you to try. Here is the answer for scenario 1, dividend payment. The earning per share is obtained by dividing the total earnings by the number of shares outstanding. The share price is calculated by multiplying the earning per share with P/E ratio. The share price will drop by the amount of dividend paid after the dividend payment. Therefore, the share price before dividend is paid is higher by the amount of dividend, £3. The market value of equity after dividend is paid is the share price multiplied by the number of shares outstanding. Now, assuming that in scenario 2, the company could use the excess cash of £300,000 to repurchase some of its own equity, a tender offer of £30 per share is made. Answer the following 5 questions. Again, there is a little answer at the end of this slide to motivate you to try. Here is the answer for scenario 2, share repurchase. The number of shares repurchased is the excess cash of £300,000 divided by the tender offer price of £30. The number of shares outstanding reduced by 10,000 after the repurchase. The earning per share after the repurchase is the earnings divided by the new number of shares outstanding. The share price after the repurchase is the earning per share times the PE ratio. The market value of equity after repurchase is the share price times the new number of shares outstanding. Now, let's compare the impacts of dividend payment and share repurchase. With dividends, each shareholder owns a share worth £27 and receives £3 in dividends, so the total value is £30. This figure is the same as both the amount received by the selling shareholders and the value of the equity for the remaining shareholders in the repurchase case. Earning per share increases under a share repurchase. The market value of equity after the excess cash is paid out to shareholders is the same at £2.7 million. Why do firms choose repurchases over dividends? Well, several reasons have been given for stock repurchases. First, stock repurchase is flexible. Dividends are sticky in the short run because managements are reluctant to raise the dividend if the increase in dividend cannot be maintained in the future. Managements dislike cutting cash dividends because of the negative signal a dividend cut gives. Therefore, if excess cash flows are expected to be temporary, managements may prefer to make distributions as share repurchases rather than to declare increased cash dividends that cannot be maintained. Second, stock dividend is a means for executive compensation. Companies that use stock options as employee compensation can repurchase shares and then reissue those shares when employees exercise their options. This avoids having to issue new shares, which dilutes earnings per share. Third, stock repurchase can offset dilution. It can be used to modify a firm's capital structure. For example, a repurchase can remove a large block of stock that is overhanging in the market and keeping the price per share down. Fourth, firms choose repurchases when they believe that their common stock is undervalued in the marketplace. In addition, a repurchase announcement may be viewed as a positive signal by investors because repurchases are often motivated by management's belief that their firm shares are undervalued. Fifth, from the shareholder's perspective, a stock repurchase, as opposed to a cash dividend, has a potential tax advantage. The stockholders have a choice. when the firm distributes cash by repurchasing stock. They can sell or not sell. With a cash dividend, on the other hand, stockholders must accept a dividend payment and pay the tax. What is a stock dividend? Stock dividend is a dividend paid in the form of additional shares of equity rather than in cash. It is paid to existing shareholders. In a stock dividend, investors simply receive additional shares in proportion to the shares they already own. No cash is distributed, and no real value is transferred from the firm to investors. It is not a true dividend because no cash leaves the firm. It represents nothing more than a bookkeeping shift within the shareholders' equity account on the firm's balance sheet. Stock dividend is normally expressed as a percentage. For example, a 20% stock dividend means a shareholder receives one new share for every five currently owned, which is 20% increase. Let's look into an example on stock dividend. An all-equity firm has a total market value of 660,000 euro and 10,000 shares. The share price is 66 euro. With a 10% stock dividend, how many shares will there be? The number of shares will be 10,000 shares times 1.1 and is equal to 11,000 shares. Question 2. How much will each share worth? The share price will be the total market value of 660,000 euro divided by 11,000 shares and is equal to 60 euro. Question 3. An investor had 100 shares before the stock dividend. How many shares would he have after the stock dividend? How much is the total value of his equity before and after the stock dividend? Before the stock dividend, the investor had 100 shares at 66 euro per share. After the stock dividend, the investor had 110 shares at 60 euro per share. The total value of his equity before and after the stock dividend remains unchanged at 6,600 euro. The investor's total wealth will not be affected by the stock dividend. What do you notice from the previous example on stock dividend? The effects of stock dividends are as follows. First, the number of shares outstanding increases. Second, the share price reduces. Third, the total market value of firm remains the same. And finally, the total value of equity owned by investor remains unchanged. Stock split is an action taken by a firm to increase the number of shares outstanding. Shares is split up to create additional shares. It is commonly used to lower the market price of a firm stock by increasing the number of shares belonging to each shareholder. Quite often, a firm believes that its stock is priced too high and that lowering the market price will enhance trading activity. Stock split is normally expressed as a ratio. For example, in a 3-for-1 stock split, each old share is split into 3 new shares. Let's look into an example on stock split. In this example, the background of the company is the same as our previous example on stock dividend. An all-equity firm has a total market value of 660,000 euro and 10,000 shares. The share price is 66 euro. With a 2-for-1 stock split, how many shares will there be? The number of shares will be 10,000 shares times 2 and is equal to 20,000 shares. Question 2. How much will each share worth? Each share will worth 66 euro divided by 2, and the share price decreases by half to 33 euro. Question 3. An investor had 100 shares before the stock split. How many shares would he have after the stock split? How much is the total value of his equity before and after the stock split? Before the stock split, the investor had 100 shares. After the stock split, the investor has 200 shares. The total value of his equity before and after the stock split remained the same as 6,600 euro. Calculated by 100 shares times 66 euro or 200 shares times 33 euro. Again, what do you notice from the previous example on stock split? The effects of stock split are as follows. First, the number of shares outstanding increases. Second, the share price reduces. Third, the total market value of firm remains the same. And finally, the total value of equity owned by investor remains the same. Do you notice that the impact of stock dividend and stock split are the same? Please review. Finally, we have come to the end of this video. I hope you have benefited from the presentation and content in this video. If you like this video, please click like, subscribe or share. Thank you, see you and goodbye.